Market cycles often begin with a vertical climb that defies standard financial logic, creating a sense that the usual rules of risk no longer apply. This is the trajectory of the LAB token. It rose from 7 cents to $27 in a single continuous move, a 12,000% increase in value. For retail investors watching the ticker, the price action suggested a success story driven by massive organic public demand. This rapid accumulation of wealth made it difficult for buyers to look past the returns and investigate the underlying mechanics of the asset they were holding. Then, the structural integrity of the market failed. The price collapsed 77% within a 2-hour window. This chart shows the speed of the decline, a nearly instantaneous erasure of value. The total damage amounted to $6 billion in market capitalization. In regulated stock markets, trade-halting circuit breakers would have triggered within minutes. On the blockchain, there were no systemic guards to slow the descent. Since capital in a closed system is transferred rather than destroyed, this $6 billion drop represents a massive shift of liquidity from one group to another. Finding those billions requires looking past market sentiment and analyzing the blockchain as a digital crime scene. The blockchain functions as a public ledger, maintaining a permanent record of every transaction and the specific addresses involved. Investigators reviewing the data from those 2 hours expected to find a wave of panic selling from thousands of individual retail wallets. The ledger showed the opposite. The vast majority of the selling volume originated from automated routers rather than human users. These routers utilized proxy contracts. A proxy acts as a digital shell, executing network code while masking the owner's identity. These proxies allowed synchronized token dumps, offloading massive volumes without the market seeing who pushed the button. The decentralized architecture of the network provided the tools to build a centralized mechanism for this hidden liquidation. Crypto investigator Zach XBT traced the flow of tokens back through these proxy layers to find their point of origin. His investigation revealed insiders controlled 95% of the total LAB token supply, leaving only 5% for the public. This restricted supply meant even modest retail buy orders created extreme upward price pressure. The insiders used the structural leverage to manufacture the 12,000% rally, generating the price action needed to attract secondary buyers. The $6 billion crash occurred when these insiders finally opened their hidden bags, dumping their holdings into the demand they had spent months cultivating. The 2-hour crash appeared to be the conclusion of the event, but the data suggests the operation is still active. During the initial sell-off, the insiders were unable to liquidate their entire 95% stake. They were limited by locked tokens, specific portions of the supply that are physically barred from being moved by the smart contract's code for a set period. This time lock function, visible in the underlying contract code, currently holds a massive cache of remaining insider tokens in a frozen state. The smart contract's hard-coded restrictions eventually halted the liquidation, physically preventing the insiders from dumping the rest of their holdings until a later date. There are currently 282 million LAB tokens sitting dormant in these locked addresses. Based on current market prices, that frozen supply is worth approximately $1.35 billion. The blockchain contains a specific release date for these assets. On August 14, 2026, the smart contract will unlock these 282 million tokens, making them available for trade. Given that this insider ring already extracted $6 billion in a single afternoon, the upcoming release of a billion-dollar arsenal represents a significant risk to the remaining market. The blockchain provides a transparent record of these risks, but that data only serves as a warning for those who examine the code before the next unlock.